Good afternoon, everybody. We're going to call to order the Corte Madera Town Council Special Pension Workshop. Rebecca, do we have a roll call, please?
Yes. Councilmember Casissa?
Here.
Councilmember Lee?
Here.
Councilmember Ravazio?
Here.
Vice Mayor Kuhnhart?
Here.
Mayor Beckman?
Here, thank you. Please join me in the salute to the flag. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you, everybody. With that, it is public comment. This is the time for public comment. This is for agenda items only, as this is a special meeting. Any members of the public who are in attendance and would like to comment on our agenda item may do so by raising their hand via Zoom or emailing publiccomment@tcmmail.org. Rebecca, do we have any emailed public comments?
Just a moment while I move the town manager over. We did not receive any emailed public comments on this item.
Great, thank you. And we have no hands up from our one attendee, so we're going to close public comment. That brings us to item 3, which is our one business item, the pension workshop, and I will turn it over to staff, consultants, and I believe our finance ad hoc committee for a report.
Thank you, Mr. Mayor, members of the council. I would like to introduce our team for the council. We currently have our finance subcommittee on the call. That committee consists of Annette Desano, Larry Reed, Carl Spurzum, Jim Andrews, and staff, Daria Carrillo and myself. We also have the town attorney, our new interim town attorney on the call, Amy Ackerman. And we have our financial advisors from NHA advisors, Mike Myers and Craig Hill. Just brief background. Our ask tonight, it's not for this council to figure out in a 30-minute presentation all the mechanisms to what we're going to talk about tonight and opportunities with funding and funded liability with the pensions. It's a continued conversation. This process is really probably 4 to 6 months. And really what we're asking the council to consider is to allow us to initiate and begin this process, which after this meeting would be us coming back to you at the upcoming meeting in November and really starting the legal mechanism to continue this conversation through this year and the spring of next year, but to position the council to ultimately make a decision on should we restructure our unfunded liability and consider bonding that unfunded liability. So this presentation, we're not gonna, it took me 3 to 4 presentations to really wrap my head around it. And so don't feel like we have to have all the answers tonight, but we think this is an opportunity to really consider this moving forward. And with that, I just want to walk you through what really got us here. This goes back over 10 years ago, with some of the pension reforms that we've made and used, every tool in our toolbox possibly available to the town. That consisted of, major pension reforms. Pepper helped us a few years ago, and we've talked about that a lot as a council and a community, but also we made other reforms. We consolidated our public safety services, both in police and fire, which allowed us to get around the California rule that doesn't allow agencies for current employees to change their pensions moving forward. And we were able to do that, moving away from the 3% at 50 formula to 3 at 55, which was a significant savings to our residents in Corte Madera over the coming 40, 50 years, period. The other thing is, if you compare the town of Corte Madera and some of the reforms that we've made recently related to what our employees pay towards pension cost, miscellaneous employees pay 12.5% to 13.5% of those costs. Compared to our cohorts in Marin and the Bay Area, the average is 8%. And so we pay more. Our public safety on the fire side, when we reformed classic employees from 3% at 50 to 3% at 55, they also pay 15% of pension costs moving forward. And so there were a lot of moving parts over the last few years, successes for us as a town, working with our employees to really get them to understand the importance of sharing this cost and this burden. The other piece is, over the last few years, we've talked about having the right software programs to really understand what our unfunded liability is in the moment, in this moment of time. And when we make decisions moving forward, we have the capability to understand what those decisions, how they impact us 10, 20, 30 years from now. We opened a pension trust, and we built through economic development about a $1 to $1.2 million funding stream to start to fund our retiree health and pension unfunded liability costs, but to control those pots of money here in Corte Madera, to invest them the way we want to invest them, and to control those monies. Those pension trusts have grown to $3 to $3.5 million respectively, and that continues. And we've talked about that a lot, of really now forming a policy moving forward between now and 2035 of really paying off that 20-year amortized CalPERS number. But that is only as good as the revenue streams available to us over that period of time. And it's one of the last attachments in your document. If you really look at it between now and going out 5, 6, 7, 8, 10 years, you can see what our projected revenues are available to us to go towards the pension funds. And it ebbs and flows. It probably averages $500,000 to $700,000 annually. And so it's a great tool. We're one of the agencies in the Bay Area that are ahead of the game, but we're only as good as our revenues. The last tool in our toolbox when we think about pensions, of what our responsibilities are as a town moving forward, and any tools in our toolbox to really think long-term of how we pay off these unfunded liabilities, there's one last tool in our toolbox. It's one we haven't considered in the past because there's a lot of moving parts to it. Historically, there's been a stigma to it. And lastly, it has to do with opportunity. And so if you look at where we are now, and I'm going to turn it over to Mike Meyer for the advisor group, our financial advisors, to really talk about this, it's opportunity. If you look at the bond rates right now, they're in the low to mid, 3% percentage points. And so that's important because right now we're paying off our unfunded liabilities at a 20-year amortized rate at 7%. And so really the crux of this conversation is, I don't want to say it's a savings by going from 7% to 3.5% and repackaging this into a 20-year amortized payment plan. That's what we're doing, but it's the arbitrage, right? So if you look at 20 years saving or setting aside $500,000 to $600,000 annually now available to us, how do we spend that money via policy? So at the end of the year, we look at how CalPERS did, and let's say they did what they should. We have $500,000 or $600,000. We can move it to the pension trust. We can move it over to our retiree health trust fund. We have options, and it's an evaluation each year of how we look at this. And so I don't want anyone to think for 1 second that staff is telling you, let's refinance this thing over 20 years to save $500,000 annually. And we can use that however we want. That money is needed to attack this problem of pension issues that we have. We need this money. And so if you look at doing this refinancing, we could add $500,000 plus annually to our already committed $1 million rate, of what we've been doing recently in the past years. And so it just gives us more tools in our toolbox. But this is really the last tool in our toolbox unless the Supreme Court changes the rules related to pensions. One last piece that I just want to share. When we looked at this as staff, really, we look at it from the, I don't take it lightly to ever talk about bonding because I don't think, it's not something I would recommend lightly to anybody in this room. But when you think about pension cost, out of all of the liabilities and responsibilities that we have as a town, per law, per bankruptcy court, the first thing that we are committed to paying is our pensions. It just is. And so I think when we look at this and we start to have this conversation starting tonight, but moving forward, this starts to make some sense of really serious conversation of should we do it. And so what I'm asking tonight is for you to hear the presentation, hear from our finance subcommittee of really the conversation and how they look at this issue too, because they all bring something really important to the conversation, and it's something your staff relies on them very heavily on. We gave a presentation to the subcommittee last year, and at the time, we just didn't think that due to the interest rates and the situation at the time, that it was worthwhile bringing something to the council. As the coming months went along, and recently Larkspur and other cities started taking it up due to the opportunity with the low bond rates, we brought it back to the subcommittee, and we've had a series of meetings. And ultimately, we as staff and a subcommittee agree that we should bring this to the council for some consideration to initiate the process. We're not agreeing tonight or at any point this year of doing it, but you have to start the process. And again, Mike will walk you through what that looks like, and it's in our presentation. And with that, I'll stop talking. And what I'd like to do is Mike has about a 25 to 30 minute presentation of really the background and breaking it down so we can all understand it. And then I would also, at the end of that, I would like to turn it over to the subcommittee for them to share some thoughts that they have and have had, you know, for us to think about moving forward and really give the council an opportunity to engage our team as well. So thank you.
Thanks, Todd, and good evening, Mayor, honorable council members. I'm Mike Meyer. I'm a VP with NHA Advisors, and I also manage our pension group. And this is a group that started about 5 years ago with all the changes that were going on at CalPERS. And, you know, I think our group works with about 4 to 5 dozen cities across the state on anything from basic educational materials to evaluating cost management strategies. And the UAL restructuring concept is something that statewide has been a lot more activity this year. It's something we've been quite active with. It's a very nuanced financing technique, and I hope that with tonight's presentation, we'll talk pretty openly about the pros, but also the cons of doing a UAL restructuring. As Todd mentioned, it's about 25 slides. I think we'll have time at the end for Q&A, but feel free to chime in if there's a slide you'd like me to spend more time on, or if there's any questions. So I'm gonna attempt to share my screen here. Coming through okay to everybody? Yeah, great. Let me just, there we go. So just from a high level, we're gonna start out talking a little bit about just what CalPERS costs are, some background on CalPERS, talk about historical cost trends that the town has experienced, and then looking forward, what those costs are projected to be over the next 30 years. We'll get a bit into some of the more cost management strategies. There's about 3 or 4 we'll touch on, and then we'll really spend some time focusing on the UAL restructuring concept in more detail. So just as an executive summary, as you probably know, the town's unfunded liability has grown to a little over $21 million. It's about 142% increase over the last 9 years. That's been a pretty big impact to the town's budget. It's currently about $2.2 million for the town's CalPERS costs. That's up from $1.3 million 5 years ago, and higher pretty quickly. And we do have some charts in the presentation that also reference the costs that are paid by the town, but that aren't the town's plans. So these include the Central Marin Fire Police, as well as the San Anselmo plans, because the town does pick up about 1/3 of those. So I want to clarify right now that the UAL restructuring that we'll talk about later really focuses on the town's unfunded liability, but we think it's important to, when we're looking at the projected costs in the future for the town, to fold in those other costs from those shared plans, because they are moderately large numbers. As we'll get into, the repayment of that $21 million is not, it's not a level payment. It's not like a mortgage. It's almost made up of about 45 different mortgages that are on different terms. And so when you stack them all together, you'll see that there's a big peak in payments over the next 10 years, followed by a big drop off. So not very conducive to long-term planning. Just quick background on the city's two plans. The town had, or sorry, town miscellaneous plan. There's 163 covered members. Most of them are retired or transferred. There's like 33 active. And then, as you know, the safety plan is now closed, so there's no active employees, but the town is still paying on the unfunded liability. In terms of the annual cost that the town makes to CalPERS each year, there's two components. The first of which is what's known as the normal cost, and that is the annual cost for current employees. And then the second component, which is the larger component, and it's the one that's growing very quickly, is to amortize what's called the unfunded accrued liability. And so this is really the difference between what the town currently has in assets with CalPERS versus what it's going to need in the future to pay retiree benefits in full. And so because this number is large, it's large for all agencies statewide that participate in CalPERS. CalPERS doesn't force you to repay it all at once. They amortize it over time at a 7% interest rate. And as I mentioned before, there's different pieces of that debt that all have amortization ranges from 14 years to 29 years. And we'll look at what that repayment shape looks like in a few slides. In terms of why we're in this situation, why agencies statewide are facing this issue, unfunded liabilities were not even a thing back in the late 90s, early 2000s, primarily because investment returns from PERS were in the double digits. So most plans were above 100% funded, what's known as super funded. Over the last 20 years, we've seen sluggish investment growth. I think the average for the last 20 years is 5.5%. CalPERS has also changed their assumptions several times. So their big assumption is what's known as the discount rate, which is their expected return in the market. That was 8.25 back in pre-2003. It was ratcheted down at that point in time to 7.75, down to 7.50 in 2013, and then just this fiscal year finished up lowering it to 7%. And so really the combination between has driven up unfunded liabilities very quickly. Some other reasons are mortality rate assumption changes, just given that people are living longer. And notably, from a cash flow, from a budgetary standpoint, the other big change they made in the last 4 to 5 years is that they've reduced the amortization period for agencies to repay the debt. So it used to be stretched out 30 years, which, yes, more interest is paid over time, but it also isn't such a big impact to the budget. Now they're compressing that debt to be repaid over 20 years. So that's just the agencies are forced to repay it a little bit quicker. Just in terms of historical costs, again, this is the miscellaneous plan of the town and the safety plan. You can see that on the left graph in the dark blue, that's the normal cost. There's been a little bit of an increase, but not a huge increase. Where you see the big increases are in the light blue. That is the cost component to amortize the unfunded liability. So you can see in 2014, overall costs were about $400,000 for that plan. Right now, they're about 1.1 million and projected to grow. And then on the right chart, that's the safety plan. Very similar trend, although you'll see in the, let me move this box here. 2022 is when the normal cost was projected to go away. That's probably already happened now, given that the town has closed that plan, but the payment of 1 million there is allocable to the unfunded liability payment, not any normal cost. So this is really the chart that I think is the most important leading into the next parts of the presentation on managing these costs. But this on slide 10 is the next 25 years of projected payments. And so in the gray bars, this represents the town's 21.4 million unfunded liability amortized at a 7% interest rate. So that's when I mentioned earlier the uneven repayment shape, this is really showing that the majority of the UAL debt is amortized in the first 15 to 20 years. And then there's some components that are layered in on the back end that have longer amortization periods. And then what we did here is we also layered in the 8.8 million, which is the town's share of the other plans, the San Anselmo plan, as well as the Central Marin Fire and Police. And so in dark blue there, that's the Central Marin portion. In the teal is the San Anselmo portion.
Mike, what's the relevance of that San Anselmo portion? Is that because of our shared safety services?
Yes, when we consolidated, Mr. Vice Mayor and council members, we basically shared the cost 3 ways of Twin Cities Police Authority's current liabilities with San Anselmo. The numbers mathed out accordingly, and so this is our share of what we owe for San Anselmo's.
And is Larkspur not relevant to this graph?
No, Larkspur is also, so this is an important question. So Larkspur is also shares 1/3 of the cost as does San Anselmo. We wanted to show Central Marin Police Authority the unfunded liabilities here because we thought it was important for the council to understand that historically we've been just talking about the town's unfunded liability, but we also are responsible for 1/3 of the unfunded liability for Central Marin Police Authority, which is a portion of that is San Anselmo's cost. But when we're talking about the ultimate decision, should we bond this unfunded liability, Central Marin Police Authority, San Anselmo's unfunded portion will not be part of that conversation because they're a separate entity, and ultimately we're going to take the same discussion to the police council for the cities of, Larkspur, San Anselmo, and the town of Corte Madera to consider to do the same as we're recommending here.
Thanks, Todd. Yeah, just to that point, just to echo what Todd said, the town can't really, through a UAL restructuring, directly pay off any unfunded related to these shared plans. But from when we get into the discussion of why restructure and really the ability to have a clean slate and reshape the new debt payments at, yes, a lower rate, let's call it 3.5%. But one of the big benefits is to reshape it in a way that works best for the town. So whether that's a 20-year maturity, a 30-year maturity, and it's important to take into account these other liabilities that the town has in creating that new repayment shape.
And I'm sorry, but as you have started to refer to our obligations to CalPERS as loan liabilities or debt liabilities, are you speaking with accuracy or with generality in referring to our relationship with CalPERS as a loan or as debt?
It is essentially a debt that you owe CalPERS that you have to pay. There's a repayment schedule that's mandatory, and there's severe repercussions for not repaying on it. I don't know that CalPERS would say this is a debt. I know that the way it's treated in a court, a bankruptcy court, is that CalPERS gets paid first before a lot of other debts. So, I'm using that as it is a debt that you have with CalPERS. If that's the specific term that CalPERS would use, I don't know.
Hey, I'm sorry, quick question also on the I'll just call it debt for now, it may not truly be debt. I think you said we get charged 7%, right, through CalPERS. Is that 7%, is that fixed over the 20-year period? Or can CalPERS come tomorrow and say, we're raising that to 8? I don't want to say they're going to lower it. Can they adjust that? Is it a variable rate or is it fixed?
It's fixed for the time being, but what, there are over the last 10 years, they've started to ratchet it down as they've got more realistic with what they're earning in the market. And it's a pretty severe impact to agencies when they lower the discount rate. Even if they were to go from 7 to 6, let's say, the town's unfunded liability would likely be in the $30 to $40 million range instead of $21.4 million. This is really a snapshot in time. So yes, in the future, as they change assumptions, it will impact the UAL. And what they do is they layer in a new a 20-year amortization of that piece of the UAL. The other thing that happens is that every year moving forward, they will tack on a new UAL each year based on their investment performance. So if they, for instance, last year, they earned 4.7%, which is under their target of 7%. That is not in this chart right now because that's not part of the most recent valuation report. But come next September, what the town's going to see is probably another $2 million added to the UAL because of the 4.7%. And then every year moving forward, if they have a good year, if they have a 10% year in the market, you'll see actually a negative unfunded liability that will offset some of these costs. So it's really it's dynamic, but in terms of the peak in payments over the next 10 to 15 years that you're looking at, that will be the shape, and it's only likely to get a little bigger because some of the most recent below average performance hasn't been taken into account.
Okay, and that you kind of answered my question, but that was the other part. The 7% return from CalPERS, it sounds like the 7% isn't really realistic if they're at 4.5, a little bit less than 5. And it sounds like that's another one where it's variable also, depending on the market.
Exactly. It's their estimate. They base all the repayment schedules off of that. But you're right. You get dinged if they earn lower than 7%. So in a way, it is variable. And I know Todd and Daria and staff have been pretty deep into some of that sensitivity modeling, because I think there's a lot of people out there that don't think that CalPERS can earn 7% on average for the next 25 years. And that's really only going to exacerbate this issue.
Okay, thanks.
And so moving into the some cost management strategies that other agencies are using. The first one on the left is to prepay your annual UAL payment in July. So early in the fiscal year, the town does receive about a 3.5% discount. This is something that the town has historically implemented. The second one is what's called a fresh start amortization, which is where the town would go to CalPERS and request a new repayment schedule that would be a little bit more even. So it would be growing in a linear fashion at about 2.5%. Couple negatives with this option. The first of which is, historically CalPERS allowed you to pick any term that you wanted. So you could actually lengthen it or you can shorten it. Their new policy is that you can only shorten the repayment period. So the benefit is you save on interest costs 15, 20 years down the road, but it requires higher payments in the early years. The other downside of this option is that the town would be locked in. So once it goes to the new structure with higher payments, you can't go back to the old shape. Because of that, this is not often used. There are other ways if the town does have more cash or more annual revenue that it wants to apply towards pension costs. There are ways to do that, which gets into our the third option, which is really the most common option. It's something that the town's already been doing, and it's really to use reserves or excess monies to contribute more than you need to. Two ways of doing that. The first of which is a 115 trust. This is a separate trust that is not managed, well, at least for the town, it's not managed by CalPERS. But once money is put into that trust, it can only be used for pension or OPEB expenses. So this is a way to really lock up funds for pension and OPEB, but also earn a little bit more money than you typically would with your general fund monies, because those are restricted in terms of what types of assets you can invest in. The second option with using cash reserves to pay extra is to send that money directly to CalPERS, and you tell them which pieces of the UAL you'd like to pay off with that. Obviously, those require, this is above and beyond what you're currently paying to CalPERS each year. So usually this would come out of reserves or additional annual surplus revenue. And then lastly, the bonds, which, a pension bond is essentially, and we're going to get into more detail, but issuing a bond and using that money to pay off some or all of the unfunded liability with CalPERS. And then you restructure those bond payments in a way that works for the town. And we'll get into some of the benefits and the risks and more detail on that market because it has changed quite a bit over the last year. This slide 13 is really just a little bit more detail on those options I just mentioned, so we can skip over to, I think, 14, which is really a high-level overview of a UAL restructuring. As I just mentioned, it could be a public offering where a bond is issued to investors, or it could be a private placement, which is essentially a bond that's purchased by a direct lender or a bank. There's two for towns and for cities. There's really two alternatives in terms of the bond structure. The most common is a pension obligation bond. So this is an unsecured debt. You don't have to put up any collateral. It does require a legal validation process though. And this is I'd say a 3.5 to 4 month process at best. With COVID, we've seen a little bit of a delay. But that really is the first step in this process. As I mentioned, it takes about 3.5 to 4 months. And once that's complete, the town does have the ability to go out and legally issue a pension obligation bond, although there would be further approvals required by the town council. The second option is a lease revenue bond. So a little bit different in the sense that it requires assets to be pledged, whether that's city-owned buildings or the street system of the town. There have been a few cities recently that used this structure just because of they wanted to get into the market earlier. They also didn't want to go through the legal process of the validation. But for the most part, I'd say 2/3 of the recent agencies who have issued these restructuring bonds have gone the POB route. The lease structure is also usually one notch lower in credit rating than a POB.
I'm sorry, quick question. On the lease revenue bond, where it has like it's being secured by streets, buildings, et cetera. Buildings, do you mean like it'd be town hall that we have? We also have Corte Madera Shopping Center, which I think there's a bank loan on there, which I don't think the bank would probably allow. I don't want second position, but something else being secured by that property. And then town hall, we're potentially looking at redoing that. So would those two assets potentially be off the table, or they have to be included in there, or is it just streets? And again, just high level at this point in time.
And I'm going to let my colleague Craig, who's on the line, I know he worked on that, the shopping center transaction, but I believe that's already collateralized through that. Buildings work, streets work. The issue with a lot of these is that the unfunded liabilities for agencies are so large. I mean, relatively speaking, Corte Madera is, 20 million. Most of the recent transactions have been in the 100 to 500 million range, and most agencies don't have buildings that have enough value to collateralize that. So a few have used streets. Our firm just worked with the city of Torrance in Southern California for, it was a $350 million lease bond. That was their only option, was to use the streets to kind of meet the lease requirement. That's pretty nuanced. That's something that, investors can't come take the city's streets. It's really just a way to meet the legal requirements. That is something we aren't, I think, tonight, if after kind of working through this process, I think the one ask of council is whether the validation process is something that you would like to look into further. But obviously we could answer questions on the lease bond structure as well.
Thanks.
So, we're going to get into the benefits as well as the risk, but also right off the bat here on 14, I'll mention that the big risk with any restructuring is what's known as reinvestment risk. So while it's very easy to say CalPERS is at 7%, our bond is at 3.5%, there's tremendous amount of savings. That's an estimate. The savings from a pension bond is dependent on CalPERS future returns. So we're going to get into the detail of that. But what it means is that at a high level, the town is better off, let's say in 25 years, if CalPERS earns above the bond rate. So if they earn above 3.5%, the town has come out ahead on the pension restructuring. If CalPERS earned lower than, let's say, 3.5%, the town would have actually paid a little bit more. And we'll get into more detail on kind of how that works in a few slides. In terms of the market, we've seen, for about 8 years, there was no market for pension obligation bonds because of the Stockton and the San Bernardino bankruptcies. Those investors lost a lot of money because those cities had issued pension bonds which were unsecured. And so in those transactions, CalPERS, I believe, got paid first. Bondholders lost a lot of money. There wasn't a lot of interest by investors. Also, interest rates were higher, prior to 1.5, 2 years ago. And then started in 2018, we started to see a few higher rated issuers get into the market. I think at the time it was Laverne, which isn't even listed here. They were 2018, they were a AAA city. And then you saw more traction and more appetite from investors that were willing to purchase POBs. And so all of a sudden you started seeing some AA agencies get into the market. And now we're seeing actually single A rated agencies into the market as well. So generally speaking, the interest rates for these have been on the low side. We actually just did a small private placement for one of your neighbors, the Novato Sanitary District, for a little over 2.5%. That's a utility, sewer revenue back transaction. On the high side, little over 4% level. And it's really dependent on the credit rating of the agency, market conditions. We've seen tremendous volatility this year in the bond market, given COVID. Obviously the security or the structure, as I mentioned, the rating. And then a big thing is the term of the debt. And that's what we'll get into in terms of options, because there's no one way, no one way is right for every agency. We've seen structures that are all across the board in terms of shortening the maturity, extending out to 30 years, having, escalating payments versus flat. And so we'll get into some of those options in a little bit.
Mike, two quick questions.
Uh-huh.
Is the placement of a rating part of the validation process, or are you looking at other independent agency ratings?
So the validation process is a legal process that gives the town the ability to do a POB either now or 10 years down the road. It doesn't lock you into anything. If there was, during that process, if there was, I think, agreement that the town was going to move forward with this structure, the credit rating comes very near the end. So once you have all the preliminary official statement, which is the prospectus for investors, you give that to the credit rating agencies, you get on the line with them, you walk them through your finances, introduce management to them, talk about the restructuring plan. They look at the economy in general and will assign the town a rating. And you're already rated, I believe, AA or AA plus right now. So they're already doing annual surveillance on the town.
And can you talk at all about our closest neighbor, Larkspur, and their experience? And why are they AAA and us AA plus? Because we have a stronger economy than they do.
And also, if we know what interest rate Larkspur got, I think that would be helpful.
Yes.
Yeah, great questions. You put me on the spot with the AA plus versus the AAA. I haven't really got into the differences in terms of how S&P is looking at Corte Madera versus Larkspur. I don't, my colleague Craig might be able to chime in. It might have to do with revenue diversity in terms of sales tax versus property tax. You are by far on the higher side of general fund credits. I'd say the majority are in the high A, low AA category. So AA, AA plus, AAA are very much on the higher end. I jumped to this chart just because I got the Larkspur question. Larkspur's interest rate was in the low 3s They did 100% of their unfunded liability, about 18.3 million. What we really wanted to show with this slide is that, and we obviously there wasn't enough space for all 20 deals, so we wanted to show a few samples, but there's a very common strategy of kind of chopping off the peak in payments over the next 15 to 20 years in all of these. Beyond that, each of these entities kind of had a different strategy when it came to how, beyond year 15, they wanted to structure the new debt. So Larkspur was probably the shortest maturity, which was another factor that led to their lower interest rates. So they kind of mimicked the current peak, and then they had the payments drop down considerably after 15 years. So similarly, Riverside, which is a transaction our firm worked on, they chose to really flatten out the peak you could see in the orange line, and then their payments dropped down towards the end to mimic the current shape. And then on the other end of the spectrum, you have Hawthorne, who chose to just level out their payments for the next 30 years. And West Covina, they did about a 25-year deal with a 2% escalator. And really, this is meant to just show there's no one size fits all. This is part of why this process is very nuanced. If, as our firm is working on a lot of these projects, and typically during the period of evaluation, you could really go through dozens and dozens of options to really determine which shape works best for the town, given your financial constraints, your objectives, something we like to call resiliency, something that we will, jumping ahead a little bit, but one, it's very nice to look at this as a snapshot in time, but I think what we all know is that CalPERS is going to have some down years in the future, and making some assumptions as to what that does to this shape, I think is very helpful to really look at the resiliency that different repayment shapes give you over the long term.
Our actuarial liabilities are not graphed, and they could be significantly different from Larkspur's, just if there's a significant demographic difference among the employees, right?
There are some differences, but I think what you'll see in most of these shapes, and it's kind of demonstrated here, is that everybody has an unfunded liability, and everybody out there, for 99% of the agencies out there, have most of that compressed in the next 15 years. So this peak in payments is a very common shape for every CalPERS agency statewide. The one slide I kind of skimmed over was just taxable interest rate trends. So, one of the reasons we've seen, I think, more activity in the market is that rates are low. If you look at the last 30 years, we're at close to historical lows. The chart in the upper right is just the last 12 months. So you could see there in March, at the height of COVID, there was a large drop. That was literally the bottom in terms of taxable interest rates. And then it's kind of bounced around since then. Currently, the 30-year treasuries in the mid 1% range. So now to just really walk through a few, what we wanted to do is show 3 very preliminary options that are tailored to the town of Corte Madera's numbers, just to talk at a high level about kind of the new payments that you could expect if you were to pursue a restructuring. And as I mentioned, we could run dozens, if not more, of these during the actual evaluation process, but we wanted to kind of give you some bookends. So a 20-year maturity, in a 30-year maturity, and then something in between, a 25. And for all of these, we just made the assumption that about 84% of the UAL is paid off, so that your new funding ratio is about 95%. Obviously, you could go to 100%. You could also do something lower as well. So the chart on 19, just to start with the bars, this is the town's current payments that we looked at earlier. So in gray, that's for the town. And then in the green and the blue, those are the payments on the shared UAL. And so the goal with each of these was to take the new debt and layer it in a way that created a smoother shape overall for the town over a certain time period. So you could see in the purple line, that's option 1. That's the shortest maturity. It's level through 41, and then it essentially goes to 0. And then on the other end of the spectrum, you have the 30-year in dark blue, and that stretches out to 30 years. And then the orange one is 25-year right there in the middle. And really the concept is that the longer you go out, the lower the level of your new repayment, because you're stretching out those payments. So you have more savings in the next 15, 16 years. Anything above these lines are projected savings, right? So from the top of the bars down to the line, that's projected savings. So the longer the maturity, the lower you get to bring down that line. However, you're paying extra out in the out years. So those are now added payments, which will impact the amount of cumulative savings. And we'll see that in the next chart with the numbers.
Hey, Mike, quick question. This 84% or 95% funded, where did that come from?
Good question. So we have been part of a number of these. I think the range has typically been 60 to 100%. And it really comes down to your preference, your risk tolerance, and what you're trying to achieve. I would say that typically the low 90s to mid 90s is a common target that a lot of actuaries will recommend. There's some folks who say that if you go to 100%, that's a little risky, because what happens is if CalPERS actually has good years, they won't send you a check. If you get up to 102%, 103% funding, it would be nice if CalPERS actually allowed you to share in that benefit. They're not going to send you money. So oftentimes there's some reasoning to just keep a little bit of UAL on the table, so that when they have those good years, you have something that can be offset, if that makes sense. Now, if you're under the thought that, you know, CalPERS is not going to hit 7% over the long term, you know, going to 100% might not be a bad idea, right? So we also just wanted to,
right?
They did 100%. And, you know, the one thing that's not built into these too is what's going to happen next year from the 4.7% that PERS earned in fiscal year 1920, which was through that you know, the early part of the pandemic. So even though Larkspur did 100%, they're at 100% funding ratio. The very next report, they might be down to 96, 97. So I think there are some, just given that that hasn't been built in, as well as kind of this consensus that a lot of people think 7% is going to be hard to hit. You've seen some agencies getting more comfortable with 100%.
Got it. Thank you.
And so lot of numbers here on 20, but this is really, we actually have more numbers in the appendix that I won't bore you with, but essentially those numbers are the backup for the chart we just looked at on the previous page. So it'll show year by year what your current payment is, what the new payment is, and what the annual savings is. So as you know, when Todd mentioned earlier, you know, this could be 500,000 a year, or it could be $1 million a year of additional savings. All those numbers are laid out by fiscal year in the appendix. So slide 20 is really just a recap. So all three assume the same amount, just to keep it apples to apples. And then moving from left to right, if you look at the interest rate and kind of the average life of the debt, which is really the blended maturity, you can see that it gets higher as you move out along the yield curve. So for the shorter 20-year deal, it's about a 3.5%, 25-year about a 3.7%, and then on the 30-year a 3.86. I will say we're being a little conservative here because it's so early on in the process. The market moves, it's been moving 20 to 25 basis points within weeks, just given what's going on in our political environment with the pandemic. So we always like to start slightly conservative. This is obviously something that even at the soonest, you probably wouldn't deciding on until March, April of next year. And so I think it's always best to start with conservative estimates on the rates. And then, on the present value is a common metric in the bond market. And this really looks at the future savings and discounts it back into today's dollars. So to tell you how much those savings are worth today. And you could see that ranges from about 4.3 to 5 million. Where you're going to see the big difference between these scenarios, and it's why we chose these three to start with, is the cumulative savings row in the middle versus the savings for the next 15 years, because those are inversely related. So as I mentioned, if we start from the second row from the bottom, the savings in the next 15 years on that shortest maturity, it's about $9 million or about $550,000 per year. As you go to the longer 25-year maturity, that savings goes up to about 13.3 million or about a little over 800 grand a year. And then as you go to the longest option, a little over 16 million for the next 15 years and about $1 million a year of savings. Now, the inverse is true if you look at it on a cumulative basis, because those longer options are adding payments in an area where you didn't have payments before. So you can see there that the 20-year option actually creates the most savings overall, because you save a lot in years 20 through 30. So that's about 5.7, and then 1.6 million for the 25-year, and then it's negative on the 30-year option, because the added payments in the out years outweigh all that savings in the first 15 years, if that makes sense.
Can I ask if any members of the Finance Committee have seen these numbers previously or have views on this?
We've seen these numbers before.
You have?
Yes.
Yes, we've seen this presentation before. Yeah.
And Larry and Annette, do you have a take on the nature of these choices? I mean, it seems to me that although the shortest one offers the greatest savings, in the short run, we're paying more. And the longer one offers...
David, it sounded from what Todd said at the beginning that we were going to get to that kind of, after this presentation wraps up, then we'll get the Finance Committee's take on it.
all right.
And discuss with them from there.
Fair enough.
Thank you.
And so before we jump into the benefits and also the risk, which I really want to focus on, I think it's clear that the inverse relationship between cumulative savings versus short-term. And then again, I want to bring up the word resiliency, because I think the one thing we like to do, which is probably in 2 to 3 months, if this were a process that the council wanted to look at in more detail, is to say, okay, this looks great right now, but this assumes CalPERS earns 7%. What if we have another 08 recession? What if CalPERS only earns 5 to 5.5%? How does this shape now look? Because there's a lot of, I think as it relates to some of the shorter maturities, the optics are nice with the lower rate. It's nice that there's interest rate savings in the back end. But I think what you'll find from a resiliency standpoint is that there's not much capacity to withstand a near-term downturn, because it just lifts that shape right back up again. So that's something that we always recommend, whether it's us doing some of the stress testing, and we do have a slide in here that I won't spend too much time on, but typically we've brought in an actuary to actually do a stress testing analysis as part of it. So those exact options I talked about were something we recently did, where we said, okay, what if there's another 08 right after the town issues a bond? What happens then? Are we better or are we worse off? And I think that's helpful from going into something eyes wide open to quantify those risks, but it's also helpful in determining which shape actually might work best for the town. So
I'm sorry, quick question on stress testing. Do you stress test them plus or minus, 25, 50, 7,500 basis points plus or minus?
On the borrowing side, we can do that very quickly. So we could say, okay, here's what it looks like at a 4% rate, 3% rate, 5, whatever it is. But in terms of the future CalPERS returns, we are not an actuary. We can do things, and we have a slide on here about, what happens if the market crashes right after you give CalPERS $21 million. At which point are you worse off having done the pension bond? When it comes to a little bit more granular stress testing, like saying, every year from here on out, we want a different assumption. Usually a firm like Bartell and Associates or an actuarial firm produces that pretty quickly. And it's something that actually on I think all but one restructuring project, we've actually incorporated into the evaluation process. Again, that's something that would happen much later on if this is something that you became more comfortable with and wanted to pay for that service from the actuary.
Okay, so it sounds like one piece is stress test and the other piece is worst case. Again, like you mentioned, if the market crashes. And the other also, does the rating affect the longer out you go versus short term?
So there has historically been concern that you don't want to go to a rating agency and say we're extending our debt. What we've seen is that no one has been downgraded through an extension. We've worked on some that go 30 years, some that have been shorter. Having a plan is the biggest component to the rating process. And so one of the things that I wanted to mention towards the end, but having a policy in place that kind of goes with the restructuring is part of the credit rating score. The credit rating agencies don't want to see folks using this as a last ditch effort to fund a budget gap, but they want to see a policy in place that says, here's how we're going to leverage those annual savings. And whether that's funding up other reserve accounts, or if it's going into the 115, we have a lot of agencies that will set up policies that, the strategies that I mentioned earlier, they're not mutually exclusive, right? So if there's projected savings, to put policies in place that actually say, okay, every year we're going to take X% and put it into the 115 so that we could continue addressing these pension costs. The other thing with these bonds now that's different than 10 years ago is that they're all callable. So they can be paid off in 10 years. So all those factors are a long way of saying that the rating agencies haven't really dinged anybody for going out to 25 or 30 years, as long as it's part of a well thought out plan.
Okay, and if they're paid off earlier, there's no similar to a mortgage loan, even though they're totally different, prepayment penalty type thing?
So typically, 10, 15 years ago, most of these pension bonds had no prepayment option. So a lot of agencies are stuck with their pension bonds paying higher rates. In today's market, it's the most standard is a 10-year call feature. So you can't pay it off in the first 10 years, but come year 9, come year 10, there's no penalty for paying it off, whether it's because you've set aside cash and you just want to get rid of it, or at that point in time, you can actually refinance it at a lower rate. You'd have that option. It's like any other bond. It's very similar to, I believe, the COP you have outstanding.
Thanks.
So just a quick summary of benefits and risks. And I know I'm going a little above time, Todd, so cut me off if you want. But, benefits, lower interest rate, obviously. I think the peak in payments being eliminated really helps in the next 10 to 15 years with budgetary savings, and obviously having a more predictable structure is helpful for planning. I know that rating agencies do look at the increased funding ratios as a positive. In terms of the risks, as I mentioned, the big risk is reinvestment and market timing risk. And this is the main concern of the Governance Finance Officers Association when they came out in 2015 and cautioned against agencies doing this type of transaction. And it's what I mentioned earlier, that the savings is dependent on future CalPERS returns. So the town is better off on a present value basis as long as PERS earns above the rate paid on the bond. So if that's 3.5%, you are better off having done the restructuring as long as PERS earns above 3.5%. does mean that if PERS, let's say, earns 5.5%, the savings we looked at earlier, which is based off 7%, is a little optimistic. So if PERS earns 5.5%, let's say that the town did a 25-year transaction, you paid 3.5% interest rate, PERS earns 5.5%, you still have generated significant amount of savings, but it is lower than what we projected based on the 7%. So that is really the unknown, and it's the exact reason we like to incorporate the stress testing, so that you can get a better idea of what those savings actually look like if there's below average performance by CalPERS or some sort of big market event.
Just quick question again, theoretical. I guess there would be a point of time where it wouldn't be worth it for us to do, because again, we don't know where rates are going to happen next week or even like 4 or 5 months from now. So again, theoretically, if bond rates went up 250 basis points from what they are now, there may be a break-even point, right, where it may not be worth it for us to do. And again, sometimes I just look at worst case. Yeah,
I mean, that's a great comment. I mean, I don't think as an advisory firm, we would, if rates are up at 4.5%, 5.5%, I mean, your wiggle room between the CalPERS rate is much less there. So the odds of this being a successful outcome in the long run is much less if interest rates are higher. I mean, the other component here that's very hard to time is the equities market. So people theoretically would say the best time to do a POB is when borrowing rates are low and you have a lower stock market, because the odds of that CalPERS having better returns in the future are higher. Unfortunately, it's hard to time both. That being said, this is something that, there's a lot of moving parts, as Todd said, with as some of our clients get closer to actually looking at an issuance. That is one thing we will take into account, because there's a lot of nuances of when you give CalPERS that money during the fiscal year. So if they, let's say, we're having a bad year, the market tanked post-election, we would actually probably recommend that you hold off until the end of the fiscal year, because you don't want to get penalized. There's a lot of moving parts with how CalPERS works on the investment returns, but I bring that up just to say it's another component that we're thinking of in terms of when might be the optimal time. The tough part is, none of us can predict the stock market into the future.
So it's almost like we go through the process, we tee the whole thing up so it's ready to go. And at that point in time, it's either, I want to say go or no go, depending on market conditions.
Yeah, and I think the point of this initial conversation is talk about the concept. If the council wanted this option, let's say 4 or 5 months down the road or years down the road, you got to go through the validation. But where you would actually have the final say, I mean, there would be a lot in between then to kind of evaluate the market and options, but is when you actually go for final approval, which would be 4 or 5 months down the road. So yeah, you would be looking at, okay, where's the market now? Where are interest rates? How do we feel about these stress tests in terms of our comfort level? And then it's a go, no go at that point, or let's delay till something's better with the market, right? So there's no...
Right, I'm sorry, just one other question, I'll let you get on because I know we're getting short on time. Is if we go through that valuation process, is that valuation process good for X amount of months? In other words, like say we're through with the validation process, we're ready to go at the end of May, we decide to hold off. Does that mean we can come back in September and go, here it is again, so you don't have to reevaluate, you don't have to re-stress, but.
Yeah, I think most of those stuff will be fairly constant in terms of the stress tests. I mean, unless the borrowing rates move a lot, if let's say we assumed a 3% rate on the stress test that you'd be paying on the bonds, and now the market's at 4%, well, that impacts your likelihood of savings, and so we probably want to redo that. The validation is good forever, so as long as the documents are written the right way, which they will be. This just gives the town the ability to execute a POB if it wants to, as soon as this spring, but also 10 years down the road. They're good for, obviously, as there's we have some clients like a Riverside who did POBs in 03 and 04. Of course, more UAL came online. And so that validation still worked this past June. They didn't have to wait for a validation. They were able to just get into the market when they wanted to because that validation was still good. So you're able to, once you do a validation, you're able to pay off whatever UAL is current with CalPERS at that point in time.
Thanks.
Hey, Mike, can you just take us to the, just really quick, because I really want the oversight committee to be able to jump in, or I'm sorry, our ad hoc committee to jump in and the council to ask questions, but just the restructuring process on slide 26, and then any next steps on slide 28 that you want to cover.
Yeah, sounds good. This is a high level timeline. It assumes, we've obviously had a couple workshops with the finance committee. If the council wanted to initiate this validation process, I believe, Todd, what's the date in November that you were targeting?
Our November 17th meeting.
Okay, so the 17th would be approval of basic legal documents, and that's what the lawyers would need to actually initiate this process in the Marin County Court. And then let's say from January to March, this is what we would say is the more in-depth evaluation process. So typically an underwriter's engaged. They would be the firm that would actually sell the bonds. If you did go down that route, we would look at all the options that are available. The lawyers would be drafting up a POS, which is the prospectus for investors, and then obviously the credit rating process. And then if all goes as planned, I think the town would be in a position to reevaluate the market probably in April at the soonest. And one last thing to note is that CalPERS does have a deadline. So if you do want to effectuate savings starting in 22, you have to get them that money by around June 22nd of 21. So just something to, once you kind of miss that date, the first year you can really generate the savings would be fiscal year 23. So just something to add. Lastly, I think the only other thing I mentioned was the pension funding policy, and this is something we would be probably encouraging the town to look at. We have a lot of samples from other agencies that really have put together policies that talk about how they're going to address rising pension costs, whether it's bonds, 115, kind of a combination of both, but also how the future savings are being recommended to be utilized, because I think that's an important part of the equation.
And just before I turn it over to you, Mr. Mayor, and the ad hoc committee, that's something that we will vet in the coming months through the ad hoc committee to bring back to council for consideration, regardless of what you decide on this conversation, that we feel like it's necessary to do it anyway as good practice. Moving forward with our 115 trust funds, how we handle that. And ultimately Craig could jump in on this, but it'll help our ratings as people look at us as a town moving forward from a financial standpoint.
Great, thank you, Todd.
I just a quick question, 115 trust funds. When we had decided to put aside $1 million to quote prepay, was that a contribution into a 115 trust?
Yes.
Thank you.
Great, thank you, Todd. Thank you, Mike. That was a very clear presentation, very well laid out about a very complex topic. So thank you. I don't have a background in this at all, so the fact that I was able to understand and follow, I think, speaks volumes to the clarity of that presentation. What I'd like to do is go through the members of the finance subcommittee and get kind of their quick takes on this. Then we've got a couple members of the public on the line who were not on the line when we opened up public comment, and at least one of them has their hand up. So I'm going to reopen public comment, and then once we've done that, I'll bring it back to the council for any further questions, and then a discussion, and hopefully ultimately we will arrive at some direction for staff and consultants here. So I think maybe Annette, do you want to start us off here with kind of your take on this presentation? Then we'll go to Larry and then Carl.
Sure. Thanks, Mr. Mayor. Can you hear me? Is my level good? So I've sat through this at least 2.5 times, it seems like. And so you're ahead of me because I actually really got it just now, more than I have previously. I think it's a creative solution based on the sensitivity analysis that Mike and group have done. There's certainly more upside to doing this bond issue than downside. And I would recommend the council to at least begin the validation process as soon as possible, knowing that it doesn't commit us.
Great, thank you so much, Annette. Larry?
Personally, I start out with a level of discomfort with this, not anything to do with the transaction or there's a problem with pension obligation bonds, but this isn't a core, borrowing money to invest it is not a core function of municipal government. But if there is a compelling reason, if there's a benefit to the town, then it's something that the town should consider. I think between Mike's presentation and some of Fred's comments, I think, kind of put their finger on the whole thing, which is what's the return from CalPERS going to be? What's the rate on the bond going to be? At such point as the council executes this transaction, you'll know what the bond rate's going to be. You're still not going to know what the future CalPERS returns are. And so it's a question of probabilities. Do you think that there will be a benefit or enough of a benefit to justify moving forward? And that's just arithmetic. But I agree with Annette that you don't end up in a position where you can do this unless you go through the validation process, and that keeps the possibility alive for you to consider in the future.
Great, thank you. And Carl?
Yeah, I agree with both Larry and Annette. I think in one of our discussions with Todd and Daria, in terms of the maturity we might look at, really gets to the question of what can the town predictably, agree to, set up, lock themselves in to pay that won't really hit the budget that hard. So we kind of talked about, the 20 or 30 year. I think we kind of thought about the 20 year, but again, I'll leave that to Todd and Daria to come up with some inputs there. I would just commend Todd and Daria for being really creative on this. I think Todd's done yeoman's work in bringing these kinds of options to the town to deal with some pretty severe problems. So I really think we should go to the validation process for sure. We've learned a lot from Larkspur. They've been through this. I think it's a very good approach to take. So I think we should move forward.
Perfect, thank you. Thank you to all three of you. Yeah, Fred?
Yeah, this is for Todd and staff. Just two quick questions. One is, and this is more for transparency, I want to say full disclosure. What's the all-in cost, I want to say, for us to go through the validation process? That's part one. And I'll let you, and then part two is, it's my understanding, Todd, and you just clarify this, that this doesn't need to go to a vote of the residents or anything like that, right? Town council can approve this and we can move forward. Again, this is just for transparency and full disclosure.
Thank you. And I also, Mr. Mayor and members of the council, we also have one more member of the subcommittee. It's Jim Andrews. So I just wanted to offer him a second. He's a key member as well. So again, on the cost, it's probably approximately a $20,000 to $30,000 expense to the town to go through that. And yes, this validation process then allows us not to, this would not go to the voters. It's not after you go through the validation process, you do not have to take this issue to the voters.
Okay. Thanks.
Thank you, Fred and Todd. And I'm sorry, Jim, I didn't see you. I have non-video participants turned off, so I didn't see you there. So it looks like you're unmuted. So go ahead and please share your thoughts with us.
I agree with my colleagues about going forward with the validation. Once that's done, we don't have to do anything, or we can proceed onward. In terms of the length of the bond, as long as there's a good call feature involved in it, the benefit of going longer term with a good call feature gives you almost the same benefit of a shorter term without a call feature. So that's something to think about. One concern I do have about going with bonds is, my impression is that bond trustees are less forgiving about missed payments than CalPERS would be. Because if we're going to miss a CalPERS payment, we'll be joined by probably a couple hundred other jurisdictions in the state who are in the same boat. And they would, CalPERS might be more flexible than a straight bond trustee. So that's just my general observation. But I would go ahead with the validation, and then we can do stress testing on future scenarios once the legal validation is done.
Got it. Thank you, Jim. Very helpful. I thought you were on this committee, so I was like, why am I not seeing Jim on here? So thank you. I'm going to open this back up for public comment now, because like I said, we've got 2 folks on the line who were not here originally, and they both got their hands up. So we'll go to Barbara and then Roy, and then we'll bring it back to the council for discussion. And Barbara, you are able to unmute at your leisure.
Okay, I got it. Sorry. You know, thank you for letting me speak. This is the first I've heard about this whole process, and I only heard about it because I was at the mayor's talk and I was curious. And I want to say, Michael Myers, you've done an excellent job of laying out the options. Thank you. I kind of followed it. I'm not a money person at all. I'm a retired lawyer. But I must say, you know, I hope the public is going to be made aware of all this, even if though the voters are not going to vote on it. And Mike, you're probably going to laugh at me, but why isn't this all CalPERS' fault? Why does it come down to the local school boards and the local agencies having to like cut their budgets and set, you know, issue bonds to pay for CalPERS mistakes? I mean, they have this unreasonable rate of return even since the recession. It's still not reasonable. And I know their money managers engaged in a lot of mismanagement leading up to the recession. So if you could, don't laugh at me, just maybe give me a simple answer. I'll be happy.
Thank you, Barbara. And we can come back to that as soon as we close public comment. And I forgot to mention, per council rules, public comment is 3 minutes per person. You were well under that, so thank you, but I just am obligated to say. And next we will get Roy on here.
Good evening. My comment that's following is not directed at the town staff or the council. You're all doing a yeoman's or yo person's job. The 800-pound gorilla in the last commenter had mentioned it. We're talking investment returns, and it is CalPERS. So a little bit of history, and we don't know the detail on it, but according to Marin IJ, allegations have been made against a deceased Novato financier who allegedly promised annual returns of 6 to 9% on investment. The financier's company, a real estate investment and management firm in Marin, is being charged by the SEC, among other things, of running a Ponzi scheme. Now, looking at a 7% return claim. Are we talking about, let's say, Macera, CalPERS at 7%? Also, CalPERS made a decision to reward a investment manager, a former CalPERS investment manager, $418,000 a year annual pension. That's unconscionable. I think somebody we hear on TV has a term, come on, man. We're talking about 7% returns and huge pension payouts. That's unsustainable. So I don't know how we cover the CalPERS issue. And I don't know if there was any serious discussions about backing out of CalPERS. And I know that's horrendously expensive, but I mean, I just don't know how the state is going to financially sustain all these public pension funds. Thank you.
Thank you, Roy. We have no other hands up, so we'll go ahead and close public comment, bring it back to the council. I don't know if any staff or consultants want to start us off, just touch on any points that were raised. Yeah, Todd, looks like you do, and then we'll go to council members for questions and comments.
Since I have the 18 behind me, I can say anything and they can correct it, but I don't necessarily, just a couple of responses first. Process is very important. And so one of the things that we instituted, Barbara, years ago, and I think it's one of the best things we did, is we formed, this finance ad hoc committee. It was actually Jim Andrews and the council's idea a few years ago. All things important related to this town financially are to be run through the finance committee and just problem solve and think out ideas. And so this is one of those items that we actually started a conversation last year on and really developed, how we want to proceed moving forward, and really brought us to today. So have we gone out and really shared this with the entire community? No, we have not. This is the first time we've publicly talked about this issue. But as we discussed, this is probably a 6-month process. And over the next 6 months, there will be a series of meetings, workshops, community chats, really educating our community on why we're thinking about this, why it's important, and really getting people engaged in this conversation. And so, and that's important. So that's one of the things that the council really wanted, is process. So how do you develop ideas? How do you then bring it to a council? Again, this isn't a council meeting. This is a workshop. We're educating each other, talking out loud, and then hopefully getting direction on how to move forward over the next 6 months, or doing nothing at all. The issue with CalPERS, I think Roy said it perfectly in a lot of ways, but we are responsible for our unfunded liability. So whether it's 18 million, 21 million, or 40 million, however you want to look at the discount rate, we're responsible for it. It's one of the tasks. So if we were in trouble financially, before you pay the salary of your town manager, you're going to pay the unfunded liability and the obligations we have retirement wise for all your previous town managers before you worry about what you pay me, because that's the obligation when you get to bankruptcy court. And so we're stuck with that, and knowing that, and I don't like it, none of us do, we have to have a plan and as many tools in the toolbox to attack this. And this is one of the last tools in our toolbox, and that's why we're talking about it. The other thing is, we know something. So historically, moving back, I think Annette asked Mike this, and please both of you jump in. What's the historical rate of return for CalPERS going back 20, 30 years? And it's in the 7% range. Moving forward, I think everyone on this call, we all feel strongly that 7% is not reasonable. We had Bartel and Associates come in last year and do an analysis, actually a couple of years ago, do an analysis on where they think CalPERS is going to trend over the next 20 or 30 years. And they gave us an estimate of 6%. At that point, through the finance committee, we formed the pension trust, the 115 trust, and we did our own analysis based on 6%. But where we landed as a group in a recommendation of funding that pension trust is actually at 5%. It's kind of those ranges of what Joe Nation in his report with the Stanford report years ago recommended. And so that's how we're looking at this. And so we're looking at it with our eyes wide open, understanding that the savings, however we decide, if we decide to do it 20, 25, or 30 years, it's not really, it's a portion of money that we're going to have to dedicate to the rate of return, which we, your staff and finance ad hoc committee, think we should be thinking about 5% long-term. And so we have some good analysis already. We didn't just take numbers out of the sky. We had third parties that are recommended and respected in the industry provide that analysis for us. And so that's a little bit of background of how we got here and where we're going and why. And again, if the team wants to jump in, please feel free.
Great, thank you very much, Todd. With that, I'll open it up to council members for questions or comments. Who would like to start us off? David.
Mike, could you possibly put up the curve or the slide that has the 3 graphs against the actuarial liabilities? Bingo. Oh, no, bingo. That's it right there. Thank you. And make it a little bigger. Oh, now it sounds as though advice is reasonably sound that we should be moving towards getting the validation done. But in my work in financing long solar contracts and taking variable variable utility costs and generally uptrending utility costs, and then leveling them out with, in effect, a debt or a fixed payment power purchase agreement based. We always would recommend to customers that they try to choose a curve that would have them paying less than they're now paying. Now, the only one that is really less than we're now paying is the option 3 30-year. That has the significant disadvantage of having more overall costs and a negative in one of the evaluations. And the middle curve there, this is sort of the Goldilocks curve of orange, is the only one that does approximate and get under our actual obligations that we're going to have to send out the door. And although it continues higher than they would be otherwise in certain years, it also terminates, it drops down. And therefore, that orange line or something close to it would be what I would recommend over any of the others. And I'm curious how Larry or any of the members of the Finance Committee, any of the members might respond to what I just said.
And I might just jump in here 1 sec, if that's okay. This is Mike. One thing to note is that these lines also, this is a combination of the bond payment and the shared plan's unfunded liability. So it's not just the bond. So all of these are under what the town is currently paying. So that purple line is lower. Obviously, the resiliency to handle more downturns is not, as great as the lower options. But I did want to clarify that you're not comparing the lines to just the gray bars, but it's comparing the lines to the top of the light blue in all of these options.
Okay.
Thank you, Mike. That was a key piece of information. Thank you. David, were you finished?
Well, I'm curious what the reactions of any of the members of the Finance Committee are to what I said. That would, it seems to me that option, the middle option, the option 2, 25-year is the preferred.
I just speak for myself, David. These lines at, a few months from now, whenever the transaction's being considered, these lines are going to be in different places.
Yeah.
And so I've been thinking about this transaction more conceptually as opposed to, the details of how it should be executed. And then, at the time, the data will be more relevant, and that will be the time to make the decision. So I really don't have a view on this.
Well, one of the concepts that I'm getting to actually was indirectly referred to by the citizen member Barbara Solomon. One reason that we're not going out to the public is that we're not creating a new net higher annual obligation for the town than we already have. We're trying to save money on an existing obligation that we already have. And so I'm just keen on keeping that down so that we're not doing something that might otherwise be interpreted to be a requirement to go out to the public to get approval.
Well, this is a publicly noticed meeting. Like we are in front of the public right now. So
slide 20 shows that, right? Slide 20 would show you what we're currently paying now to what we would actually, again, it's a snapshot in time, but slide 20 shows the difference between the three recommendations of 20, 25, and 30 years, right, Mike? Yeah, right there.
Yeah, but this is Fred. I don't think this is a point of time where we're getting into numbers, terms, anything like that.
Right,
To me,
right.
we should be moving forward. We should be deciding on, I'm not mute. We should be deciding on the concept, and if we're moving forward with the concept because I said this before, and I think the Finance Committee would be in agreement. Between now and April and May, we don't know where numbers are going to be at. So to me, tonight, and again, from my perspective, I would recommend we move forward with the concept because I think there's more, I want to say upside than downside, because again, if we get to that point, and this is setting aside numbers, when we get to that point in April or May, if the numbers don't pan out, we just don't move forward.
Right.
So I don't think this is a point of time to be discussing that. And one other thing is I would really like to thank the Sub-Finance Committee for all the work you guys did on this. Because I think it's truly creative. And I want to thank staff also and Mike for your presentation. But again, from my perspective, I think we should move forward with the validation process.
Thanks, Fred. Yeah, Bob. And then I think Jim wanted to speak also.
Isn't that all we're being asked to do is go forward with the validation process? We're not trying to select terms or lengths of time or anything like that. We're just saying, let's start the process. We figure that out later, right?
Right.
Okay. And if that's the case, then let's do it. I think absolutely we should at least start and see where we come out.
One other thing, I'm sorry, Eli, Todd, that I would suggest is I think we need to engage the community in this process sooner rather than later. I know this is a public meeting night. I don't know if it's because of the timing and it is what it is, or if we're squeezed in before a planning commission meeting, but I would like to see more community outreach again sooner rather than later. That's just my 2 cents. But again, I think we should move forward with the validation process.
Yeah. Jim, did you want to say something?
Yes, I think an important consideration that we've mentioned and then moved on from is what our policies will be. Because let's say we went with the 30-year where everything's flat for 30 years. We will have some time periods where the town has a healthy surplus. There'll be other times where the town will be scraping the bottom of the barrel. If during the surplus periods we had a firm policy that says, okay, we will fund the 115 trust. We will also put money aside for sinking fund payments so that we can call the bond, let's say the 30-year bond earlier, then a lot of the, I guess, negative savings from the 30-year bond is due to the payments for the 25th, 6th, 7th, 28th year. But if we had money already set aside, then that would take care of that problem. So it will be, once we've figured out on the bond, how will we measure, meld it into the investment policy and go forward from there. So it's, it's like 3 or 4 moving pieces we have to do. But before we can do any of that, we have to get the legal validation. One other point is all these charts are based on CalPERS assumptions. And to the extent that CalPERS assumptions are off, our liabilities will be significantly higher. And so we should sort of think, even if we do this bond next year or the following year, if there's a bear market, we're going to have to come up with more money to amortize the new UAL. So.
Sure. Thank you, Jim. Good points. And I'm glad that you brought that back to Bob and Fred's point. So Todd, to you, the direction you're looking for tonight, do you just want us to answer the narrow question of should we proceed with this preliminary legal process?
That's correct. Give me direction and come back to you at the next meeting or
Great.
a meeting in
Great.
November.
I would support that. I think Charles might be the only one we haven't heard from on that yet. Okay. I guess it sounds like we're unanimous then that we would like staff to proceed with this preliminary explorational step, to see if we may come back later and do something along these lines.
Thank you, Mr. Mayor and members of the council. We appreciate it. We have our direction. And I just want you all to know that because I think we have made much progress and greater steps in our cohorts, but we want to educate our community, and we'll open a page and a fact sheet and really just share with the community what we've done to date and what we're trying to do moving forward, and even try to get some engagement at the subcommittee level with residents that are important. I know Roy Wilford and Barbara are very engaged with us, as examples, and to make sure that we include them into that process.
Right. And again, to reiterate, this is the very beginning of the public process. This is not we're not at some advanced stage. So with that, I think we are ready to adjourn. You guys have direction from the council. So thank you, Todd and staff. Thank you to our finance subcommittee members, and thank you to Mike and Craig for being here tonight and giving us that very informative presentation.
Thanks, everyone. Thank you.
Thanks.
Good night, everyone.
Thank you.
Thank you.